Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I was reading through some of the comment sections. They were talking about portfolio allocation, stuff like that, and I thought, you know what, maybe I should share what my approach is, kind of market conditions, ratios, and then my approach of dollar cost averaging in, kind of give you guys some charts that I'm looking at real time in platinum. I know I haven't done platinum in a while, but in a little while. And I'll show you when I would potentially add to my positions. And again, I'm not this expert short-term little trader. What I try to do is I try to time my buys as best as I can. I'm a long-term investor, and I rely heavily on market conditions and the ratios, which is the valuations, to guide my purchases. So I'm going to give you an example of exactly what I do when I went and purchased platinum, why I purchased it, where I purchased it, what my dollar cost averaging look like. You can see everything. So I'm going to use it with platinum, and then I'm going to give you one sector that I think is incredibly undervalued right now. That looks incredibly good, and it could potentially pull back more. So we might have a really good buying opportunity in that sector. So wait till the end on what sector that is, and first I'm going to go over platinum and basically the setup that I saw. So I'm gonna shrink myself up here. I'll kind of stay in the picture here. So the first thing to do is you want to look at ratios and market conditions. I can show you exactly what that looks like. I'll use it in this presentation. The ratio tells us relative value. The market conditions gets us the pricing and the timing. Technical analysis looks fantastic on platinum as well. So I did all of it. I combined the ratio with the market conditions, and I also combined that with technical analysis. So what did I look at first? This is the housing starts, and what I have in the red line, the red lines are all expansionary phases of real estate. And those red arrows are the expansion phases, and the expansion phase happens whenever you go from the average is this red line going across, that's the yearly demand average. And we expand above the average and build more homes than the average, which is called an expansion phase, which means we're expanding the housing supply faster than the average. And this is what the chart looks like. We are going into an expansion phase, which has ramifications. You want to be looking at certain sectors during an expansion phase of real estate. So this is the market, real estate market cycle. We've got the recovery phase, the expansion phase, the hypersupply phase, and the recession phase. In a recovery phase that we're coming from, it's a low inflation, low rate environment where stocks do very well. When you hit an expansion phase, it's going to be increased inflation, increasing interest rates, and commodities and precious metals usually do very well in an expansion phase. The hypersupply phase and recession phase, you want to transfer into bonds and cash because that's where you have a crash in the market. So in platinum, when I was looking at platinum, you want to understand the cost curves. And what I have in here is a 2019 South African platinum mines cost curve. What the cost curve is telling us is this is what it costs to get uranium from the ground. So the majority of these mines or companies, it takes about $884 an ounce on average. And then you've got a high cost producer, Impala, which is one of the higher cost producers, which is below the cost curve. So when we saw the crash in platinum, here I'll go a little bit bigger here. When we saw the crash in platinum, the price went all the way down to like $600. We were under the mid-tier cost producers. So I bought the living heck out of it because I know what the cost curves are for platinum. And for South Africa, they produce roughly 80% of the entire platinum market. So if you go under 800, and this is the majority of platinum being produced worldwide, you're getting a very good deal. The ratios were cheap, and I'll show you what that looks like, and we were under the cost curves. Whenever you can buy under the cost curves and you can buy the physical metal, very, very low risk entry. probably the lowest risk entry that you can potentially ever have if you're buying the physical metals. Now, if you're buying Impala Platinum stock, it's going to be very low, and you may have to be patient for the price to come back up before Impala Platinum bottoms. So you might have to be a little bit more patient on Impala Platinum if you want to take a position in that company. Now, we are past this, so I'm just telling you at the bottom of the bottom what you might want to look at. The platinum to gold ratio, it usually historically trades between 1 and 1.5. Platinum usually trades at a premium to gold at about a 20-30% premium. We are at extremely low levels. We are at below 0.5 is where I was buying it. So the relationship between platinum and gold was at an anomaly in history. It was saying that platinum was never as cheap in relationship to gold in history. So that ratio was telling us that we have a platinum favorable ratio and that it's really cheap. The platinum to gold ratio right now is 0.625, which is right here, and it's really, really low in history. I swapped some metals and bought platinum in this circle all through here. The platinum to palladium ratio is also incredibly cheap, which means that platinum is the metal to own. Historically, it's between 2 and 4. We are way down here, where platinum has never been this cheap. This is the real-time platinum to palladium ratio. It's at 0.42. 0.42 is way down here. It did reach a low of like 0.3 something. And it is still moving down, but I think we're making a low, a higher low, and a higher low. If this holds, I think we're starting to make a new uptrend. So that's looking a little bit better. From a platinum price perspective, when I was looking at this, I saw that there was a chart pattern developing. We've got a nice big long-term trend line coming through here. So I started buying right in this red circle here, all through here, in 2019 and 2020. And in the big overall pattern, just looking, it's trying to break through this last sticky area to move to the upside. Then I think you're going to see a big move in platinum. A catch-up move. Next is I cost averaged in. That was my approach, cost averaging in. I started buying platinum in 2019 because of the ratios being cheap. I got caught in the COVID sell-off, and COVID was an event. It's not a structural impact. That's how I viewed it. So what I did is I continued to cost average into platinum and other commodities since the market conditions and ratios are still good. I've been buying platinum for 2 years now. I've been cost averaging in for 2 years. Because the ratios are telling me it's cheap, we've got good market conditions saying that this is probably going to turn around. And the platinum price chart looks very good as well. Everything is aligning. That looks very good. So I've got a bunch of red circles here. That's where I was buying platinum. I was trying to time my buys. I bought it here. I was buying it in here, like many times in here. It came down, and then it was like game on. This is below the cost curves down here at 600 something bucks. And I was buying. Wherever I could find this stuff with the cheapest premiums possible. And remember, the premiums did jack up during that period. I did buy a little bit coming down because I got 1 ounce because that's all they allowed me to buy at $638. But then I kept buying into a strength here, all in here. And then I haven't bought as much recently. This is what my purchases all look like buying platinum over time. And I bought a whole bunch in 2020. That's where I was really loading up. I even exchanged gold for platinum and my palladium for platinum, because platinum is a substitute for palladium in catalytic converters and in gasoline catalytic converters. The platinum price was cheap. The ratio is cheap during this period, and I loaded in where those red circles are at. So I cost averaged in. Sometimes I buy early on my cost averaging into a company. Sometimes my timing isn't perfect. That's okay. An ideal is to wait for the stock to decline and wait for the turn or a basing pattern from a large move down. So you want to wait for the momentum to slow down, it bases out, and then it starts coming back up and you buy into that strength. That's what traders do. That's what investors should do, because you're getting the best price kind of buying into strength. Plus, it's a lot more psychologically easing to buy into strength and see your portfolio go up right after buying it. So this one here, I'm going to go over some of the platinum companies. So this is PLG, Platinum Group Metals. We can see a pattern here. Here's the pattern. We are coming down to the bottom support of this. And what I would do, if it were me, is I'd wait for this trend line to break. And we're getting close down here for either hitting this support line or breaking this downtrend line. We'll see what happens. And if we get into this corner and it breaks to the upside, that's where I'm going to be buying it. I would add into it a little bit. Same with Anglo American Platinum. It's getting cheap. It's coming down here. I did add a little bit on this big, I thought we were breaking out, so I added a little bit, and then it ended down. I was like, shucks. So I still have some money. I'm waiting for it. It is coming back down, so I'm being patient here. I'm going to buy into strength. I'm going to wait for the turn to go on up before buying back into it. And Impala Platinum, we had this kind of downward movement. It popped higher, and we're still resting on the top of this downtrend line pattern. Is it gonna hold? We'll see. If platinum pulls back, which gold and silver looks like it's going to pull back here, platinum very well could pull back. We could see this kind of break back into this pattern here. But if you guys want to, I mean, it's up to you. Cost average in slowly and try to get the cheapest shares. But usually I don't buy into weakness. I try waiting for it to bottom and then buy into strength. That's, I think, the lower risk approach than trying to pick than to buying into weakness. I don't like buying into weakness. Now, the opportunity that I see is uranium. Uranium has a very low pounds to ounces, 1 ounce gold. So it's like 60 pounds to 1 ounce gold is the ratio, and it's an anomaly in history. It's never been this cheap, and I see that as a very good opportunity. When you look at the cost curves of $30-ish, we are below. Basically, we can produce up to 120 million pounds, and everything above that is getting cut off. These guys are all losing money. So anything below this is producible, but it's just at very small margins. Now, another thing I want to touch on, and this is why I think uranium is going to do very well. We are below the mid-tier cost producers or high cost producers, and the ratio is very cheap. So that's double positive there. Another thing I want to cover is what goes up more in a bull market, a low-cost producer or a high-cost producer? A high-cost producer will, because their profits are nothing when the cost is below their cost curve. They are making no money. And then when it goes way up above it, you're going to get multiples of them not making money. So they're going to go from making no money to a whole bunch of money very quickly, all feeding down to the bottom line, being earnings per share. So their earnings per share of a high-cost producer in a very fast increasing price environment will go up more than a low-cost producer if you do the math. So a quick math is one high-cost producer is making $1, a low-cost producer is making $10 at $20 a pound. So one's making 1, the other is making 10. It goes up $10. So the one who is making $10 basically doubled their profit if it went up $10. So they doubled their profit. They went from making $10 a pound to $20 a pound. The one who is making $1 a pound is now making $19 more per pound. So one is now making $10 more. The other one's making 19. So the other one was a 50% increase. The other one is 19 times their money. They went from 1 to 19. So actually they went from 1 to 20, sorry, but it's 19, no, it's 20 times, sorry, 20 times their money. So one went up 50%, the other one went up 20 times. That's what you'd see in returns. So the high cost producers, they make more money than low cost producers in a rising price environment, and when the prices really start to get away from their costs. I just wanted to make sure everybody understands that. If you guys like this content, give me a thumbs up. Thanks for listening. This is Finding Value.